What feeling do I evoke when I tell you the word revenue? How about profitability? How about taxes? We discuss all of those things with Emil Abedian, who is a strategic tax and accounting advisor to so many law firms. We talk about how to plan your growth, revenue and profitability, how to plan your taxes so you actually minimize that humongous expense, one of the largest expenses that you have in your business, and so many other things. Tune into this episode, share really great insights that will help you, should help you, increase your revenue, increase your profitability, and minimize your taxes. And also think about sometime in the distant future, probably, how you're going to exit your business, sell your law firm, and hopefully retire rich. Tune into the episode, you're going to love it. Hi there. I have a small but really meaningful favor to ask you. I watch at the stats on our YouTube channel and Spotify channel, wherever most people listen and watch our podcast. And I see that over 80% of everybody who listens to it regularly is not a subscriber. I'm asking you to subscribe to this channel. And the reason for that is my mission and the mission of my team is to help as many small law firm owners to learn how to transform their law firms into better businesses, and so they in turn enjoy better lives. When you hit subscribe button, you tell these platforms that this is content worth listening, worth viewing, and they in turn will show it to many other small law firm owners and hopefully help me fulfill our mission of helping them create a better business and enjoy better lives. So would you please do me this favor? It would mean the world to me, and hit the subscribe button. And my promise to you is that I will continue to work hard at creating good content with practical ideas that help you and your teams grow better law firms. Thank you. Welcome to Grow Law Podcast. I have a great guest with me here today, Emil from Counsel to Counsel. It's actually Counsel CPAs firm, a multi-year CPA who has been helping and working with law firms to help them accomplish structured growth, to help them accomplish tax planning, to minimize the largest expense that we have in our businesses, and to help them plan successful exit without getting slammed with a huge tax bill. Emil, welcome to the show.
Thank you so much, Sasha. Amazing. Thank you for having me.
Absolutely. Give us your quick story. How did you get to be an accountant? How did you get to be a specialist that helps law firms?
Accounting. And I always like numbers. And going into accounting school, growing up in Sweden, by the way, you think that accounting and taxes are just numbers. It's actually the opposite. It's not just about numbers. It's more about the people than the numbers.
Mhm.
So I got into accounting thinking it's all about numbers, but ended up being something else that I actually love more, dealing with people, handling with people. And as we know, money, taxes involves a lot of emotions. So we got to be kind of a therapist as well as tax planners, accountants, everything for our clients, because that's part of the industry. So that's how I got into it. And how I got into legal industry is somehow a coincidence, because I always wanted to get into one specific niche. I never wanted to be generalist. I wanted to be a specialist. Same way my thinking was, now if I have knee problem, I played a lot of soccer growing up and I had knee problem, I would not go to a heart doctor or eye doctor. I would go to knee specialist. And
Mhm.
I had the same idea. If I am a CPA working with all of these clients, all kind of industries, why am I special from my neighbors? So I wanted to get into a specific industry. It happened to be legal, but over 10, 12 years ago, because started hanging out with more attorneys. They started sending us their friends and families, their colleagues. And at that time is when I noticed the specific need lawyers have. Number one, from compliance perspective, they have this trust accounting, which is very specific from all the other businesses, and many CPAs are not getting involved with. That's a compliance work. But also, lawyers are craving advice. They want. I can feel it when I talk to them that they want this advice. They want someone who's proactive. They want someone who puts them in the right place and just tell them, do this, or actually even do it for them, because they're so busy running their firm. They don't have time to do all of this. So that's the thing. And that's why I really enjoy doing what I'm doing and helping solo and small law firms take their firms to the next level.
Interesting. I paraphrase a little bit what you said, which is numbers evoke emotions. I never thought about it that way, but they do evoke emotions. So when we think about the three main things that I mentioned just earlier, growth, like when your business is growing, it evokes an emotion that is happiness. Like to me, progress makes me happy. When I see my business grow and flourish, it's a great emotion. I love it. And the opposite is also true. If my business ever shrinks, which thank God it hasn't been shrinking like ever, we always grow, that would cause a very negative emotion. Whenever I see like my sales department stagnate, not even decline, but stagnate, it's a very negative emotion, right? But those emotions are driven by the numbers that I'm seeing. It's very interesting. Taxes, the next one, usually cause very negative emotion. By the way, I am of thinking that I love this country. I love paying my taxes. I hate how government wastes such a big chunk of it, but I don't just not mind. I love paying my taxes. But I would be happier if I paid less taxes because government stopped wasting so much of it. So that would cause a different emotion. And then the exit, right? Planning the exit, because all of us are going to exit our businesses one way or another, either by design, because we plan the exit, or by default, because we're old and tired, or we get sick, or family circumstances, something that causes us to exit the business. And again, exit can be very happy because you planned it well, you designed it well, and you get out happily. Or it can be very unhappy because you do it by default because you got old, sick, and tired, and whatever. Or you get slammed with a huge tax bill on your exit, which is a blessing, but also a disaster. Blessing because you made it, you sold it well. But then, as I disclosed to you, when I sold my first business, my tax bill was slightly over 40%. And that was like once I figured out just how poorly I planned or didn't plan at all that exit, and that
Mm.
my tax bill was so huge, that was it was a very unpleasant realization that I carried around for honestly a few years. I do not live with regrets, but that was just difficult to see how much money I wasted on taxes because of very poor planning. So with that said, let's talk about those three things that cause emotions and like focus on what are the key success factors for like properly planning growth of your business, which I know thousands of attorneys, or I've met thousands of attorneys. I talked to thousands of attorneys over the years. I've seen a handful out of those thousands who, if I asked them about like how they structure their growth, they would be able to explain it. Most cannot. So let's talk about that.
Let's do that. Let's do that. And actually, you bring a very good point there. And I preach this. I love, as you said, we are in this, we're running a business, well, whatever business we are in. I'm in accounting and tax. You're in marketing. Our clients are in legal law firm. But after all, it's a business. And we get into running our businesses for a reason. I would think, it doesn't happen overnight. It's not a coincidence that we are business owners. We get into it because we want to build something, most likely. We're passionate about this industry we're in. We want to build it. And but not everybody, as you said, and actually most of lawyers that we work with actually don't have that mindset. They're in it because they were working for a big firm. They were making the firm's partners money. And now say, you know what the hell with this, I'm going to just open up my own. I'm not going to make anybody else money. I'm going to do it myself, not knowing what it involves to run a business. They just open up a store, office, or even remote and start operating with the prior mindset that they had, the employee mindset. So they open up a business without putting I call it the business owner hat on, because as a business owner, you have millions of hats on. Hopefully, as you go, you take many of these hats off and you focus on one specific area in your business. But they don't put the business owner hat on or the investor hat on. They continue as if they're an employee of their prior firm. That's, I think, number one mistake that has to change immediately when you open up a firm. Uh, put the business owner hat on. Why is that important? I'm going to give you an example. This is probably 12 years ago, 13 years ago. One of my clients from another partnership that he had with another lawyer called me up. This is in Los Angeles, way before COVID, where downtown LA was booming. A lot of people were going and coming. He called me into his office. Emil, can you please come to downtown? I want to see you. Okay. His name is Alan. His example is actually in my book also, Counsel to Counsel, how he and his partner built this firm, which is amazing. He called me in. It was he and his Alan and Nima partners. I opened up the office in a high rise, I don't know, 25th, 26th floor. I opened up, it's like probably 5,000 square feet of an office, fully equipped, desks, offices, but it's only two people there. It's only Alan and Nima there. So what the hell is going on, guys?
2,500 square feet per person.
What?
Makes sense.
2,500 per person, exactly. They needed a big office. I said, and I knew Alan from his prior partnership, a lot smaller operation. I said, Alan, what's happening? Where are all the employees? This is the daylight, regular time. Emil, don't worry about the employees. You just tell us how you can help us. And what they did, there were only two of them, but they started that firm as business owners, not as lawyers, which is amazing to see. Right now, they have over 150, close to 200 employees. They have their own building in downtown LA. They have 40, 50 attorneys itself, not including staff. So the reason I'm telling you this is they put the business owner hat on, and they had the right mindset from the beginning, which is rare to see in the legal industry, in accounting industry, as a professionals, because we train to be professionals, not business owners. But you got to change that. You need to change that. And you and me talked about this, Sasha, a little bit earlier before we started here, how important it is to hire the right people to do the work you are doing. We are no special. We are not special. I'm thinking that, I can't hire someone who does my accounting and taxes because I know this better. Why am I better than anybody else? That's a wrong mindset. So I think, to answer your question about growth, before anything else, we need to change our mindset.
Okay, so that's a huge key success factor. But let's talk about specifics. Like, how do you plan growth? So let's say a hypothetical scenario: a law firm owner, operator, and there's a difference between an owner and operator. You may own a business but not operate it. So we're just thinking about operators. A law firm owner, operator comes to you and says, I'm looking to grow. I'm at $2 million. We usually grow 20% per year. I want to accelerate this growth. I want to get to $5 million in the next 18 months. I don't really understand exactly what it's going to cost us, and I don't know exactly how to plan this out because there's marketing investment, there's probably going to be increased intake costs, there's going to be higher operating expenses because I'm going to need to staff up. Like, how do you plan this? What's the key success factor there?
Yeah, number one, you got to budget it out. And
Okay.
in order to budget it out, you need to know. I'm not a marketing person. So we bring in someone like you, for example, say, okay, I don't know how much marketing you need to put in to get leads, but that's not my specialty. But you need a marketing team who can give us these numbers. I can do the budget for you, but we need the kind of the game, the rules of the game to put it into the budget. And in order to grow from 2 million to $5 million, how many people do we need? That we can help you out with. Okay, we need 10 more people, 15 more people. That's a cost. We need another $500,000, for example, from today to next year to go step by step, reach our goal. And how do we get this money? Do you have $500,000? First of all, maybe you don't have it. And a lot of lawyers who just starting off probably don't have it. What do? They bring in investors, not investors in form of partners, but because California, specifically California, you cannot bring in non-attorney investors. So you can get a bank loan, you can get a family loan, but you probably need an initial investment to get to that scaling model of going from 0 to $5 million in the next few years, because it costs. And it costs same way it costs for you to open up any other business. You open up a restaurant, that restaurant is not going to come to you free. You need to buy that restaurant, even if it's a ready restaurant that you're buying, or you need to spend a lot of money in the equipment, in the lease, all of that until you get your customers in to start paying it up. So it's an investment that they need to make with proper planning. Is it taking risks? 100%. Life is about taking risks. There's no such thing as 100% guarantee. use Sasha, let's say $100,000 marketing, hopefully you will 10 times that $100,000 for me in form of new clients. But is that a guarantee? Most likely not. But we need to cut the risk and make educated and calculated risk to make sure we get to those points.
Yeah, to add a little bit to this from marketing standpoint, because growth always starts with marketing. In most markets, with most practice areas, unless it's incredibly competitive in your market, like you're in LA, I believe you're somewhere around LA. And
LA.
if you practice personal injury law, it is one of the most competitive markets. I am just north of Miami. It is another very competitive market. New York City, another very competitive. If you are not in one of these incredibly contested markets, chances are you're going to invest somewhere between 12, 15, 18% in case acquisition. What that means is if you want to grow by $1 million and you have a foundational marketing, like you're not starting from zero, you're going to invest, let's say on average, $150,000 per year. By the way, it may not be a linear investment. It doesn't mean that it's $12,000 every single month. It may be front loaded. You may invest more upfront and then scale it down. But let's say you're going to invest on average about $150,000 to get another $1 million in cases, to get another million. So if you want to grow by $3 million in 1 year, there's a very high probability that you will be investing $450,000 or 15% of that $3 million over the course of that year. Why? Your competition is spending that much on getting those cases. And it's a zero-sum game. Like you cannot create more cases than there are in the marketplace. You will get them or your competition will get them. Choose. They're investing. You can't not invest and say, I'm still going to get them. It's not going to happen. So it's a fairly simple rule of thumb, usually about 15%.
It's interesting. How about in the more competitive, like in LA?
So
LA
in
area?
LA, when it comes to personal injury, you're going to look for certain hacks to lower the cost. So for example, I'm not going to give away the secrets, the name drop, but there are some very successful, also Armenian-owned law firms, PI law firms that we work with in LA that are always looking for an edge. So for example, getting a motor vehicle accident cases, incredibly expensive. How expensive? You can easily invest 25% of average case value on getting those cases. 1 in 400 accidents, we know this statistically to be true, is a catastrophic injury or loss of life. Those cases you're going to spend that same amount of money getting that case as you spend on getting a $25,000 case, but the payout is going to be that much greater. So it will skew the numbers down a little bit because you got that whale of a case that's not going to settle for the next 3, 4, 5 years, but it's already on the books. Now, when it comes to typical like MVAs or any other type of very common injuries, you're going to probably spend 22 to 25%. Why? It's a function of competition. Your competition is spending that much to get those cases. What you can do to decrease that, you can start looking at other practice areas that are within or types of incidents that are within PI, like dog bites. They happen more than you can imagine. You're not going to spend 25% on getting dog bite accidents because most of your competition is just focused on MVAs. Like malpractice cases with dentists specifically. Why with dentists? Like nobody thinks about that. We do because we're looking for a way to lower average case acquisition cost. Why do we think about dental malpractice? Easy cases. Easy cases. Dentist insurance, E&Os, or professional liability policies, they do not want to go to court. It's the last thing that they want to do. If you have a legit case, you submit a demand letter, you back it up by proof, fast payouts. Way lower case acquisition cost than 25%. It could be 10%, it could be 12%, it could be 8%. So you're always looking, if you're working with a good marketing company, they're going to look for a way to bring down the blended case acquisition cost. If you're working with someone who is in a high volume business, meaning they have thousands of clients and they just want to streamline everything, they're not going to do this because it's not how they operate, right? They just want volume of clients. Like my team doesn't do that. We're hyper focused on quality. For that reason, our average monthly recurring revenue from a client is probably a bit higher than most of our competitors. Not all, but most. Our team is considered to be creme de la creme, top 1%. By the way, this is a totally plug from my company, but I'm just explaining like some of the mechanics.
Yeah,
When
yeah,
you
I like
work
it.
with a really good marketing company, they're going to more than pay for themselves. That's the bottom line. Like they're going to be absolutely free to you. And one of the things that a good marketing company will do, they will look for an opportunity to lower the blended case acquisition cost by finding creative solutions. Like everybody goes into MVAs, you don't. Why not? It's going to be super expensive. Like, how do you make any profit when you're spending 25% on getting customers?
Yeah,
Like 50% is going to be your labor cost to actually deliver the service. You have this much, that 25% left to cover everything else and squeeze profit out of it. It's a crappy business.
that's
Yeah. So going
interesting.
back to your point, it's planning,
Great.
right? So it's planning that growth, and this is how marketers would plan it for you. They'll be like, on average, it's 15%, blah, 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 blah. You want additional $3 million, you're going to have to invest about 450 formulaic.
It's as everything else. You need to do planning. You do planning for your personal life. You go traveling, you plan. Same here. You go. You want to grow business. You need to plan. You need to grow.
Yeah,
Thereafter, you make the money. You need to plan again to not give away everything. As you mentioned, if you had done your planning when you sold your first business, you would not have paid 40% in
no,
taxes.
I wouldn't.
You probably have gone away with half of that, if not less, maybe
I,
even less.
I, I learned about it post factum.
Yeah.
After it already happened and after I already saw my tax bill, and I was like, it
That's okay. We live and learn, but that's why
was an
we're here
expensive mistake, a very expensive mistake.
so that the listeners won't have to do the same mistake.
So
Hopefully,
let's talk about the second thing, right? So growth has to be planned. That's the key success factor, and you have to wear a business owner operator's hat rather than think about seven different things that you do every day. For taxes, what's the key success factor then? I always think about tax as like once you're successful enough. I think about it as the largest expense that you have in your business. And the reason for that is the math is really simple. If you operate a $5 million law firm, there's an incredibly high probability that you're making $1 million a year in personal income as the owner operator of the business. At $1 million in personal income, there's an incredibly high probability that you're spending $350,000 on various taxes. And if you look across all of your expenses, your rent, any one of your employees, anything that you do, there's a good probability that your marketing is still probably going to be a lot less on $5 million if you're investing 15% to get those cases. No, that's a little more. That is a little more. So marketing could be a little more, but everything else is less. So your tax may be like your second or sometimes your largest expense in the business. How do we, as business owner operators, either we're law firm owners or accounting firm owners or marketing firm owners, it's all the same in the eyes of IRS code. What do we do to plan for those taxes so that we legally minimize what we're spending on tax?
100%. And again, I think it goes back to our first point of how to grow your business. We do it by planning. What I typically say when I get a new client, and again, we only work with law firms, so it's very easy to make an example. Law firm partner comes to me, they pay a lot of taxes. Being in LA, we have big portion of our clients are contingency based firms, personal injury, employment law, workers comp, and the plaintiff side, and they make good money. That's the reality. And the first question they ask me, what can you do? How can you help me save my taxes? So you know what? I'm not a scientist. I'm not a doctor, even though my parents wanted me to become a doctor. I didn't, unfortunately. But what we do different is that we plan. And we plan by being part of our law firm's journey throughout the year and not only see you once a year to prepare a return. Because if I see you once a year, I can't help you. There's not much. What am I going to do? You're going to give me your numbers. I'm going to put it into my tax software, spit it out, and give it back to you. What is that? Go to H&R Block. They will charge a fraction of what I'm charging you.
Everything that happened already happened, and you cannot change the past. That's
You
not
can't do
planning.
anything.
No.
There's nothing I can do. Even
Do
if you come
not.
to me, how's
Good.
that?
Oh, I was going to say, do not ever creatively cheat on your taxes. The
Don't
most
no.
famous mobster of this country, I think, Al Capone, for all the bad things that he and his mafia organization did, he never got caught. He never got convicted on any of it. He did get convicted on tax evasion.
Tax
And
evasion.
he spent the rest of his life in jail over tax evasion, not the murders, not the bootlegging, not all the other things that they have done. Tax evasion.
You do not, honestly, you don't need, if you run a legit business, you don't need to cheat. There's so many ways you can reduce your liability in a legal way, and we can touch on few, but it requires planning. You
Yeah.
need to work with your advisors, CPAs, whoever you're working with throughout the year. And in order to accomplish that, we created this package for our clients where if someone comes to me for just return preparation, I won't take them on. I will be straight up tell them, I won't be able to help you. I do not want to be a compliance guy. I want to provide value to you. And in order for me to work with you, I need to see you on a quarterly basis at the very minimum. Sometimes we see our clients monthly. I need to do your accounting on a monthly basis. So I see it right there. I don't want you to send me financials and for us to assume that you're making this much money or assume that is correct. That's bullshit. I want to see the numbers. I want to talk to you on a quarterly basis. I want to do tax planning from this time. October until December is like heavy duty tax planning season for us. We're probably busier now than we are during regular tax season, in order to do what you say, in order to be able to strategize, implement strategies to reduce the liability for whatever situation they have. The situation you are in, Sasha, is different from XYZ or myself. So that requires for us to get involved throughout the year. That's I think that's what it is. There are millions of things you can do depending on your situation. Whether you implement real estate uh, in the tax planning, uh, or you're implementing other leverage investments to do tax planning, or you just do regular 401ks or cash balance, which are low hanging fruit stuff that everybody should do anyways. But there are millions of things that could be done.
Yeah, that's a really good point. I also always think about professionals, service providers such as yourself are always net positive rather than net negative. And to me, that thinking is, to put it simpler, you're always free. Whatever the check that I cut you, I know that I'm getting back a lot more because my tax bill is so huge. So if you do help me ahead of time to plan so that my tax bill is actually lower, whatever I'm going to pay you is probably going to come back to me at a rate of 10 times, 15 times, 20 times. Sometimes, if you're a really high income earner, it could be 100 times plus, right? So it really depends on what it is that you would be paying otherwise. So there's, for those of you who do not work with a planning professional, and you're making decent money, like decent money, it is probably costing you to not hire someone like Emil, rather than this is the way that I'm saving money. I'm paying my CPA $700 a year, once per year, to do my tax returns. It's an illusion that you're not spending the money. You're spending the money. You're just sending it to IRS and your state revenue authority, tax revenue authority, rather than, well, you understand. So planning there is definitely
That's a
of
really good
paramount value.
point you bring it up. Like sometimes we get clients coming to us or potential clients, they just tell me, and when I give them the price, whatever that is, doesn't depending on what the situation is, but oh my God, that 10 times more than I'm paying. I'm paying $1,500 a year for an entire year.
And what are
1,500
you
is
getting?
that's a waste of money. I rather
Mm,
pay $100,000 and get $1,000,000 back. That's a $900,000 gain. Right now, you're wasting $1,500.
yeah,
So yeah, it's
yeah,
all about how you see it and how you do it. And you don't necessarily have to make millions of dollars to save from tax planning. If you make $300,000-400,000, which a lot of lawyers do nowadays, especially in our area here, uh,
mm,
you can make significant amount from proper planning.
yeah, absolutely. If you don't mind sharing, if there is a common thread, like what are very common tax planning ideas or tax reducing ideas that you help your clients implement? If there is
Let me
such a
give.
thing as common.
There are depending on situations, but let me give you an example. Real estate. Again, I'm talking about my area here. I think it's a trend now. A lot of law firms are buying their own properties
Hmm.
for their own firm, and without proper planning, those that property will not go to waste, but you won't be able to utilize the tax deduction from it.
Why not?
But because you're a lawyer, you're not a real estate professional, and those losses without planning property will just go waste. You not gonna go waste. You gotta keep accumulating until you sell the property. God knows when. 20 years from now, 30 years from now. You want the deduction now. You don't want to wait with the deduction. So what we
So
do,
I want to geek out on this one for a second. I know a little
yeah,
bit about real estate because I spent my first career for 11 years was in real estate finance, and I went quite far in it. So when you buy a commercial property that you're renting to your own business, it's another entity, right? Your building is entity number one. Your business that runs that property is entity number two. Even, well, I guess your entity number two can acquire property and hold it as an asset. But if you have it as two different entities, right?
it
So
should be
your
different, by the way. It
should
should be
be
two
should be
different.
different, right?
Yeah.
So I cannot give that advice because I'm only saying out loud what I know, but I'm not an expert. So your law firm pays rent to the property that you purchased as an individual, or it may be LLC, whatever it may be, right? So there's that expense that you're creating for the law firm, as you would be paying rent anywhere else. You're just paying it now into your other business. And your other business takes that in as revenue against all of the expenses that you have on that property. So, for example, it's interest on your commercial mortgage, it's taxes, it's insurance, it's maintenance cost, repairs, and then there is depreciation. What can you not write off if you set it up like that? If you're not a real estate professional,
You can write off all of that.
okay?
But the loss, let's say you pointed out depreciation. The
Yes,
depreciation is a big one, which could possibly, even though you cash flow positive, you have
yeah,
cash available, you
yeah,
might still show loss on
of
the tax
course.
return. If you don't plan for it accordingly, that loss cannot be deducted against your law firm income. You need to be able to
Well,
plan
but it
it.
can be deducted against my personal income because I am the
No,
owner of that property. Why not?
no,
I
because
didn't
it's a
know that.
no, no, no. It's because it's a passive in general rule. Now I'm talking about the general rule, and then we have to break it down into the loopholes. But the general rule, real estate is a passive business, unless you're a real estate professional. And in order to be a real estate professional, you have to spend more than 750 hours every year within real estate and more than 50% of your total activity. Let's say if you're a lawyer, 2,000 hours a year, then you have to spend more than 2,000 hours a year within real estate to be qualified to real estate professional. That's when you can deduct those losses. Now, there's an election with proper planning. There's an election you can make, even though those properties in an LLC and your corporation is in another entity, S corp, let's say, right? You can make an election to legally, not not legally, tax wise, not legally. You still legally want to keep them separate. Tax wise, combine them as one entity so that now you convert this real estate into active business because it's rented to your own law firm, which is an active business.
I've never heard of
That's
that.
yeah, that's called self rental. If
Hmm.
it's not a self rental, you're not a real estate professional, and if it's not a short term rental, which Airbnb style, you're a lawyer. You're not allowed to deduct your losses against your any other income unless you have other passive income.
Interesting.
That
So,
that's it. There are
so,
ways around it so that you can do it, but you need to plan for it.
so I used to own residential real estate that I would rent out. I wasn't
Mhm.
able to take depreciation deduction on my personal income taxes. Is that because it wasn't a commercial property?
No, it was probably because you were a real estate professional. That was that all you were doing?
No,
Then there are some limit. You can do that $25,000
it was
is the max.
probably somewhere thereabout.
Yeah. So that we're
Got it.
talking about that smaller amount. But when I'm
Very
talking
small.
about commercial business,
Got it.
I want you to deduct hundreds of thousands of dollars. Let me give you an example right now. Client of mine bought a property in LA for $10 million, commercial property for their own law firm.
Yeah.
With cost segregation study that we implemented, basically engineering company comes in and breaks down the property in different components to be able to more aggressively depreciate it. Instead of depreciate over 39 years, which is a regular commercial building depreciation method, we depreciated a lot more aggressive and took over $2 million in tax deduction the first year they bought that $10 million property. That saved them close to $1 million or $800 to $900,000 in taxes the year they bought the property
Hmm.
because cost segregation was implemented. You have to do that. That requires planning, and also a self-rental election was made in the tax return to be able for them to take that $2 million deduction. Otherwise, they would have lost it.
Very interesting. So first thing that we discussed was planning growth. If you plan growth, you're going to make more money. As you make more money, you need to do your tax planning because that bill keeps on growing. And if you do it like these folks who bought the $10 million building, they depreciate and saved $800,000 on their tax bill that year. They could have taken that $800,000, put it back into their business, into marketing. And if they average 15% in case acquisition cost, that would have given them another $12 million, if my math is right.
Yeah, close to.
Yeah, $12 million in additional cases. No, it's not. No, like $6 million in additional cases.
What is it? Let's do the math. We are
So eight hundred
good.
thousand
We have
dollars being 15%. That's the
about
case acquisition
five
cost.
and a half, five and a half
Five and a
million.
half. So that could have brought in another 5.5 million. And if they're operating well, then their
Let's
net
say
profit margin is 20%. They would have made another
over
1.1
$1 million.
million. 1.1 million made in operating profit because they did proper tax planning with that building and saved on their taxes.
Yeah, plus the 900,000 they made, so it's $2 million really.
Correct.
So
Not bad.
it's. Let me give you another example. I just recently signed up a new client, two partner firms. They're not in the PI world, so they're making about $3 million every year, more or less. It's a very
Gross revenue?
profit.
Profit.
Two partners, so they have
Yeah.
3 million. They have a good practice
Good for
going
them.
on. And with their prior relationship with their CPA, had just been preparing the return. So they gave them the accounting that was done by a bookkeeper, and then that CPA was preparing return. So they missed out on the pass-through entity tax deduction. Pass-through entity deduction is basically an election you're making to be able to pay your state taxes, individual state taxes, through your business entity. That's just a loophole around the tax code. And that becomes the tax deductible. And in California, you can make 9.3% of your profit towards these taxes. It's a tax that you anyways have to pay, but you're converting that, instead of paying personally after tax money, you're paying from the business before tax money. So 9.3 million, and this tax code was implemented 2021, 21, 22, 23, 24. So 4
Yep.
years they missed this out. $3 million
And $3
times
million.
4 years, $12 million. $12 million, 9.3% of that, what is that?
It's $1 million.
$1 million in loss of deduction,
Yeah.
just because they pay from wrong pocket. 37% federal, that's over $400,000 overpaid taxes. Just overpaid.
Yeah.
Tax that you anyways paid. It's not rocket science. I'm not doing anything. It's in the code. I think 99% of CPAs knows this, but why are they not implementing it? Because they're not working with their client throughout the year.
Yeah, but by the way, because I've been a business owner operator for now 24 years, I have had numerous accountants who I worked with, and most of them were just that. I would bring them my financial statements in January or February of every year. They would input the numbers into their Sage or whatever else they were using for tax prep, and they would give me my 1120s for the business and 1040s for personal.
See you next
Done.
year.
Done. See you in 12 months. And the bill was what it was. And it was just a few years ago when my partner and I got the wits where we're like, maybe we're working with just the wrong person, like they're good at just putting numbers into the system, but do they help us save any money? No. We're just paying what we're paying, and there's like zero planning that goes into it. That was a big aha moment for us. So absolutely.
It's cheap, but so is the service, huh?
So you get what you pay for, right?
Yeah,
So
exactly.
so in marketing, and I think in almost any professional arena, right? It's not just the saying that you get what you pay for, but inexpensive service is incredibly expensive. Incredibly expensive. Like in marketing, we always think about it. Nothing fails as consistently as cheap marketing. Well, why? Well,
Yeah.
because you're going against like your marketing team that costs like $1,500 a month, which in this business nowadays is nothing, right? You go against your competitor who spends $10,000 a month. Who you think is going to get cases? Not you, not your team. It's just not going to happen.
Exactly.
So when it comes to Medicine is a little different of an animal because there is a third party payer that's your insurance company, right? So it's a little different, but in most other professional services, when you think about them, you're going to pay for the good advice one way or another, either through mistakes that they're going to make or through benefits that you're or rewards that you're going to reap by making the right investment. So cool. So we talked about growth. With growth comes more taxes. We talked about tax planning. At the end of it all, we're all going to have an exit. If we're not very successful, we're going to shut down. If we're a little more successful, we're going to sell and make something. If we're successful, we're going to exit rich, which comes with a lot more taxes to pay. How do we plan for that? By the way, exits, in my experience, can happen at any stage of life. You don't have to be 80 years old to exit. Like sometimes there's just a good opportunity to sell, which is what happened when I was 30 years old with my first business. Didn't like the business at all. Been in it for many years, waited for my partner to buy me out. It was a great opportunity. Sometimes there is an opportunity to exit, not an opportunity, but life forces an exit because of family circumstances or health circumstances. That happens way before the golden years, right? And sometimes it's golden years and you're just ready to kick back and play a lot more golf than you're used to. So, but planning for it is puts you puts your mind at ease that that's not going to come with a huge tax bill. So, what do we do, or what do you do to help business owner operators like law firm owners to prep for it?
Absolutely. And also to add to reasons of exiting, one reason that really applied to me is to get a restart, to do what you want to focus on,
Hmm.
to be able to scale, exit even bigger in the long term. And which was
Hmm.
what I did, because when I first started my practice, I was helping all kind of businesses because I had to put food on the table. Whoever knocked on the door, I was helping them, which I noticed later on was a wrong thing to do. I should not have done it, but I didn't know any better. So, in order to fix that, I decided to focus on law firms, as we discussed earlier. But the other business was taking too much focus from me, too much brain power. So I decided to exit from the other business, which was same business, accounting and taxes, but for all other industries. So I got rid of all my non-law firm clients to be able to focus 100% on my law firm client. Number one, simplify my life, simplify my team's life, because that's all we do, but also you can provide value to your clients, which leads to next thing. It becomes a lot more scalable operation and more of a business, so you can exit down the line in a more efficient way. And how do we exit? If I'm in the business every day doing everything, I'm doing the tax return, I'm doing tax preparation, I'm doing the bookkeeping, this is not a sellable business. It's me. If I leave, there's nothing there, there's nothing remain, it's not a business. It's just a high paying job for myself. So in order to really convert this to be able to sellable in the future and exit, is you got to convert it to business. Number one, we discussed it earlier. To be able to grow it, you need to convert it to a business. Same way, in order to sell it, exit it, you need to convert it to business. And you pointed out before, I think we started recording, is your goal is to do more thinking and less doing, because it's the thinking that is providing value. Same with lawyers, same with CPAs, same with all the businesses. If I would keep on doing my bookkeeping work myself, if I would not have the team to do it, if I would keep on doing the tax data entry myself, which my team does it now, I would not have the brain power or time to do the strategies to help my clients reduce their liability. Then I will waste my time on all the other stuff that's not value building. Same with a business. You got to convert it. You got to hire the right people to make sure this is a business, and this business can continue without you. If you don't do it, you don't have an exit, unfortunately. You got to close the door and walk out of the door.
Okay, but when we're thinking about successful law firm owners, those who are doing 2 million plus, 3 million plus, and by the way, I do not mean to diminish how successful you are if you're listening and you're doing $1 million. Just to break the threshold of $1 million is already a huge achievement because 92% of all businesses never actually reach that. So if you do that, God bless, that's amazing. But you get to the point where it's two, three, four, $5 million in revenue, and now there is a point in your life where, for whatever reason, you're thinking about this is the end of this journey. I'm going to exit my business. I'm looking to sell it. And let's say I have 6 months or a year, or maybe 2 years, or maybe 3 years, because I know that to sell the business very efficiently, usually I need about 3 years to prep for it like very well. So let's say we do have a 3 year timeline. Like, what do we do between now and 36 months from now to make sure that that exit, I love the way that you put it, is efficient, meaning like tax efficient. You do not pay, you do not want to be the idiot that Sasha was 16 years ago when he sold his business and paid well over 40% in taxes.
Absolutely. So it's a good point you're bringing. You can't decide, I want to sell in the next 6 months. I think that's already
You
too late.
you can. It's going to be very expensive.
It's going to be
Uh,
expensive, and you most likely won't get the dollar value that you deserve, because you need to prep the company, your firm, for sales and exit. And number one, first of all, if you don't have the financials, you got to prep that, because whoever comes in without financials, you can make $10 million. Without proper financials, reliable financials, they're out. They're not going to even look at you. So number one, you got to prep your numbers. So not only that, you know how much you're making, how much the numbers look like. The buyers can see that also, and they can envision it. Once you have that, you got to start planning for taxes. That's what we're talking about right now. Obviously, we want to talk about the taxes. There are millions things you can do. There are million of programs you can do, strategies you can implement to not overpay. You still have to pay some taxes. That's, you can't get away with the taxes, but not overpay in taxes. And it goes again back to the planning with what we discussed with regular tax planning, is to look at what's out there, what's working for you, that maybe it could be through another real estate, for example. I'm not saying it is, but it could be through another real estate vehicle where you buy and get a massive depreciation on a property from these sales, and get a depreciation from it and offset your capital gain you're getting from the sales of your business, for example. So it depends on what you want to do. Let's say if you're 80 years old and you want to retire and don't get involved in any kind of operation, then obviously that real estate is not a good deal, because even though uh, even though it's passive business, you still have to get involved. But if you're 45, 50 years old, so you know what, I'm going to get out of law, I just want to do something else that's less stressful, maybe real estate would be a good thing to do. I'm just talking about real estate. I'm not any way, any
you're
form
not
or
promoting
shape
it.
promoting it.
Yeah.
I just examples that pops up. It's a very good vehicle. Tax. I think the U.S. tax code is built for real estate holdings, and when we're talking about big politicians don't pay taxes and all of this, it's because they do it right. They use the tax code. I don't think because they're cheating. They just use the tax code with the cost segregation, with the depreciation, with the multiple other venues to not pay tax on their other income. So real estate is a really good thing to do, but it doesn't stop there. It goes where, let's say you're an older person, you haven't contributed, for example, into a cash balance plan for years. That keeps accumulating.
What's a
Now you
cash
start,
balance plan?
cash balance is basically 401k on steroids.
Mm.
Instead
I've
of
never
paying
heard of
50,
that.
yeah, cash balance, or yeah, it's a cash balance program. It's basically a different kind of 401k plan with a lot higher limitations, and the limitations is not fixed for everybody. It's based on age, based on multiple factors. So if you're an older person, you can probably put aside a big chunk into the cash balance plan and get a deduction from it, and then gradually taking it out as you need it down the line, instead of taking a big $500,000 payout in the beginning. That's
Got
another
it.
thing that can be done. So there's, depending on the situation, but it all comes back to planning. Don't do what Sasha did 25 years ago. Plan for it, because it's going to cost you. Luckily, Sasha was young back then. He recovered. But if you're 70, 80 years old, 60 years old and
Can't
do this
recover.
mistake, you can't recover.
That was. I told Emil that was a yacht size mistake. We'll just leave it at that. It was a big expensive mistake. Very and lesson
Yeah.
learned. Very expensive.
Let's,
So awesome. So we talked about growth, and we talked about taxes, and we talked about exit. Emil is obviously very knowledgeable about this. So here's a quick plug for you and for your business. It is, if I'm not mistaken, counselcpa.com, CPAs.com,
correct.
right? What's the best way to connect with you and say, Emil, I'm operating this $3 million law firm here or there, and I'm just paying my 35, 40%, 38% blended tax per year. What should I do? Like, do you have any ways to reduce my tax bill next year? This year, probably a little. Oh, maybe it's still. This is going
Oh,
to
for
air.
25, we
It
starting the heavy
it
duty. 25 is still have time.
This episode is going to air around middle of November. We're recording end of September, but it's going to air around middle of November of 2025.
So as
Maybe.
soon as you listen to this, call me right away.
Cool.
Don't
All
wait.
right. What's the number?
Just get it. Just
Yeah.
email me, Emil at counselcpas.com, or my LinkedIn. Just look me up in LinkedIn. I'm on my email and LinkedIn all the time. I
Yeah.
respond to all my messages. So Emil Abedian LinkedIn, you just find it, message me.
Cool. Emil, thank you so much for sharing all the insights and being part of this podcast.
My pleasure, Sasha. Thank you for having me, sir. Have a good one.